Well, hello again, and welcome back to our free financial educational blog site, Smart Financial Future. I'm John Williams, Certified Financial Planner. You know, a lot of things change in retirement, and your taxes are usually one of them. But they don't have to be so painful. And today, I'd like to go over a couple of tips that may actually help save taxes in retirement. You know, the old saying is to be diversified. Most people, however, don't extend that to diversifying their assets by how they get taxed, and they really should. Diversifying by how they get taxed simply means you should try to hold assets in different types of accounts that will receive different tax treatment when you withdraw them. Now, you know, a lot of people come into retirement with a lot of their nest egg in traditional IRAs and 401ks. Unfortunately, when it comes time to take that money out, all of it gets taxed at your ordinary income tax bracket. For a lot of people, therefore, it makes a lot of sense to have all three types of accounts represented in your portfolio when you enter your retirement. That means Roth accounts, which will be tax-free upon withdrawal. It means tax-deferred accounts like traditional IRAs and 401ks, and even some taxable accounts where you'll be able to get ordinary capital gains treatment on those withdrawals if you buy and hold your investments. Once you reach retirement, having your assets diversified by their taxation can be quite valuable because you might be able to manage your tax bill by pulling just enough from this account or that account to stay in the lowest possible tax bracket. Keep in mind, you should always consult a tax advisor for guidance on issues like this. But the key is having those different pots of money available when you do reach retirement. So it's important to plan for that well before you reach your normal retirement age. Tip number 2. Another tip involves required minimum distributions, also known as RMDs. Starting at age 70 and a half, as many of you know, these withdrawals are required from certain types of accounts in retirement, such as your 401k and a traditional IRA. While you need to take those distributions, you can still be smart about it. First, if you don't take your RMD on time, you have to pay a 50% penalty, and that's obviously very steep. So whatever you do, make sure you take your RMD by the deadline each year after you turn 70 and a half. Another key point to remember about RMDs, don't let them take you off your portfolio plan. We talk to people often who say their RMD is going to take them over that generally accepted 4 to 5% target withdrawal rate. But don't forget, there's nothing that says you have to spend that RMD. You can actually reinvest that money in a taxable account, or if your spouse has earned income, you can think about even reinvesting it into a Roth account. And finally, it's important for people who are engaged in estate planning to remember the bite of state estate taxes. Right now, the federal level estate tax is very generous because the exclusion is about $5 million a person and $10 million for married couples. But in many states, those exclusion amounts are much, much lower. You can die with a much smaller estate and still have it be subject to state estate taxes. Here in our location in West Virginia, they don't collect state estate taxes. But according to a recent article that I read, there are 16 states that currently do. So, some of the mechanisms such as trusts that might not be so necessary when you're planning for federal estate taxes might in fact be quite beneficial at the state level if you happen to live in one of those 16 states. This has been John Williams with the free financial educational blog site, Smart Financial Future. Don't hesitate to let us know if you have any questions, and we'll see you next time.